Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor. All right, welcome to another episode of Future Money, where we talk about the investments of the future
that will make us money.
Welcome back. We have a special guest back by popular demand.
Yeah. Mr. Brett
Sifling.
Yeah, happy to be here.
Yeah.
And hopefully can provide a little insight for you.
GKOG. Brett's one of our, really one of the rising stars of GK.
Yeah.
Rising star meaning he's been with us for a long time. Youngster.
Hey, I'm turning 30 this year.
He is turning 30.
Oh,
Can you imagine?
I got 3 more months of youth left. All
Wow.
right, I gotta live it up.
Yeah, listen, Brett's the one, not one of the younger guys anymore. Okay, you know, we have people in this firm who were born in the 2000s.
That's true. That is crazy.
Which is kind of nuts, considering I graduated. This year would be my 25-year high school reunion. So, anyway,
you're dating yourself.
Thanks for listen. I do it at least once every episode where I date myself, and it's fine because that's him. Because you're older than I am, so
totally.
So it's okay.
It's wisdom, man.
Exactly.
It's wisdom. That's how I call it.
Exactly. And so Brett is our resident crypto expert, and we're going to talk about crypto, Bitcoin, all the it's obviously in the news a lot. Because
so many questions for you, dude.
So many questions. We'll see if you have any answers.
We'll see. It's the Wild West out there.
It's a Wild West.
But first, we would be remiss if we do not do the once a year revisit to market corrections. How do we deal with them? What's going on?
Yeah.
Should we freak out?
Yeah.
Et cetera, et cetera.
I mean, listen, they're always unsettling, right?
Yeah.
Like every market correction feels like it's the end of the world.
Yeah.
It's just the reality of money being emotional, right?
Yeah.
So this week, second week of March, and NASDAQ on Monday was down almost 5%, 4% basically.
Yeah.
We're basically down almost 10% on the S&P.
Well, we hit 9.9% yesterday.
Okay. And that's literally the definition of market correction, right?
It's 10%.
10% from the top, right? A bear market is 20% from the top.
Right.
We
were getting close on the NASDAQ. I think we were down 14 or 15
Correct.
on the NASDAQ from the high.
And this is the index, right? Single stocks have down a lot more than that, right?
Yeah. In fact, actually, the research, LPL's research yesterday said that the average stock in the S&P is down actually over 18%.
Correct.
From its highs.
What's interesting too is I saw that the equal weighted S&P index was actually flat on the year.
Yeah.
And so, people talked about so much over these last 6 months about wanting a broadening of the market.
Correct.
And this is
Now
what
it's
they're
happening.
getting. Yeah, this is what they're getting, right? And everyone's not too happy. So
at least for a month, we're getting a broadening. There was a lot of talk about Mag 7. Frankly, if you've been in the industry as long as we have, Hatem and I especially, we've had this argument over and over and over again. Big tech is too big; it keeps getting big, and every year it got bigger, frankly. Yeah. And I don't know if this is going to be the year that it changes or reverts. I said I don't know if it will be.
Tesla is down 50%.
Tesla kind of doesn't really belong with the rest of the Mag 7 as far as I'm concerned. We've kind of always felt that, not because it's not a good company, not because of Elon or whatever, but because of its incredible volatility. It doesn't have when I say the companies Apple, Amazon, Google, Nvidia, Microsoft, they have these very large power bases essentially, where they have multiple businesses that all feed in, and they have huge cash flows.
Business.
Yeah, and they're huge cash flows when we talk. And Tesla just doesn't fit that criteria as far as I'm concerned. Now, when you talk about innovation, maybe they're more innovative theoretically than the other companies, but to me they don't qualify. If anything, I'd put Netflix over Tesla in that conversation.
They're kind of missing the cash cow.
Yeah. They don't have a cash cow.
Yeah.
And their cars are great, and obviously Elon's causing a lot of controversy right now.
Yeah, well, we're not gonna keep talking about him. Sorry for bringing it up.
You riled him up.
So sorry for bringing it up.
No, I'm not talking about Elon. I'm good. Yeah. No.
But anyhow, so let's talk about corrections, right? You know, again, when they happen, they're very traumatic in many ways. People get freaked out, news, market crash and blah, blah, blah. But the reality, we have a 10% correction on average once a year.
Once a year.
Right?
And if you listen to this podcast,
right,
you've dealt with it every year. And we've had one podcast every year that was dedicated to it.
Right, exactly. And every time this happened, it was an amazing buying opportunity, right? For the last 100 years.
Yeah.
Right? But also, like, what I heard from my clients is, and maybe we should answer this time is different.
That's always different. It's always different. It's always different, except that it's the same.
I think, listen, you have to be empathetic to the fact that what drives corrections every time is different.
Absolutely.
But in essence, they're the same.
That's correct. This time it's different. And I would venture to say that your client probably lives in California and LA.
Well, it's politically driven.
It's politically driven. We're a lot more sensitive in Southern California to the Trump whatever that he does.
And that polarization, like I'm seeing a lot with like my own client base too, is like I have, clients from like that I'm working with maybe from back home that are a little bit more conservative. I grew up in the Inland Empire, so a couple hours outside LA. And they're like calling me wanting to add cash, and they've never been more bullish, even with everything that's going on. And then I have other clients that maybe are on the other side of the political aisle that are scared to death. Right. And kind of navigating both of those is definitely been an interesting experience.
Yeah. And frankly, that's what we get paid, right? Like you try to temper that. You know what I mean? You can't make decision based on your political beliefs. That doesn't make any sense.
Yeah. In fact, we're going to go through, one of the things we're going to do today is we're going to go through some data, right?
Yep.
Which actually shows us what to do during these times.
Yep.
And that's exactly right. Political beliefs are not conducive to investment returns.
Yeah.
And we see that across the board. And we understand, especially from those who are, more moderate to liberal, that Trump's policies and his rhetoric,
pun intended or pun intended?
Huh?
Pun intended?
No. Trump's policies and his rhetoric are very scary.
Right.
The way he says things and does things.
It is.
Yeah. So it makes people feel worse than the overall environment. And I think this is a great segue to kind of get into what we've been talking about here. Because let's rewind for 2 seconds and remember that we had a plus 20% year for the last 2 years in the stock market.
Right.
So a 10% pullback is not bad. Okay.
It's healthy.
We need market corrections for new money to get in, right? People need to add money. I can't keep buying the same stock or the same ETF at a higher price every single month, year, whatever the case may be. So
true.
Yeah. So so we're going to go through some sort of charts and data.
Yeah, we have our chart book here at GK that we put together, and it really kind of goes through a lot of the data that really helps inform some of the decisions that we make and some of the conversations that we drive.
Yeah, I love
clients.
this data, by the way.
Yeah,
it's great.
That's why we have it.
You know me. Yeah. You know me. Data is like my favorite thing in the world.
Right. I'm the emotion guy. Dude.
Yes, you're the emotion guy. Exactly. So the first one is just, last year we had a 23% market year.
Yep.
And that sounds amazing. But frankly, actually, that is the most likely scenario that we have a 20 plus market year when markets are up. That actually happens most frequently when markets. So we always say, the long-term average of the market is 10 to 11%.
Yeah.
But it's actually shocking how few times it does 10 or 11%.
It rarely does.
It almost never does.
But that's law of averages, right?
Correct.
It's either plus 25 or minus 10.
But you figured over 100-year period, you'd have a few more that were just at the mid.
So in 100 years, 38 times, the market was up 20% or more.
Correct. And by far the most of most of those.
Yeah.
So that's not out of the ordinary. All right. If we keep going, people will say, it's markets are too high. We have to sell or whatever. So let's talk about what do we do? Like when markets are so high, what happens if there's a correction? What do I do? Should I sell when the markets are high? Right? Because there's this adage, right? Buy low, sell high.
Yeah.
When in fact, I would say the adage should be buy low, don't sell. And when there's low again, buy again.
Buy more.
Right? Because you're not really selling. You're not trying to time the market.
Right.
Right. So let's kind of scroll forward.
Scroll. So keep it consistent.
Keep it consistent.
Keep it consistent.
So this is when people are nervous and they want to sell markets or they're scared because Elon's doing something with Doge or whatever. They want to sell, right? Well, this chart is actually one of my favorites.
Yeah.
Okay. And it shows the market over 25 years.
Yeah.
Okay. And it starts in 1999, so very near what was a
high,
a decade market high,
right.
And then we had the dot-com bubble burst, and then we had 9/11 after that.
I have a lot of shit the last 25
Global
years.
financial crisis,
and then the financial crisis, and within that, 2000 to 2010 was the worst decade in the history of the stock market.
The lost decade.
The lost decade, as they call it.
Yeah.
Brett was, just a little baby.
I was in middle school.
Just a little baby. Hatem was already in this job. I was just starting this job when the financial crisis happened.
2006, man.
Yeah.
2 years.
Perfect timing.
Financial crisis.
I started at perfect timing. I started in 2009. Yeah. To 09. You couldn't get anybody to invest in 09. But basically, what I like to tell people is like, imagine you invested in the S&P 500 in 1999. And you just, you did the Rip Van Winkle. You fell asleep. Do you guys remember that story? You fell asleep for 25 years. You don't remember that story from like high school. The guy fell asleep before the American Revolution and woke up after the American Revolution. Yeah.
Smart.
And so you woke up 25 years later and discovered you had this account. You put $10,000 in, it was worth over $60,000 with all the crazy corrections, everything that happened.
So 6x your money.
6x your money. You did nothing.
Years.
You didn't add another dollar, nothing. Okay. If you missed just the 10 best days in that market, basically that cut your return in half.
10 best days in 25 years.
In 25 years.
Yeah.
So hold on, 365 times 25. What is that?
Well, there's 250 trading days.
Okay.
Right? Times 25.
Oh my God.
Right?
So
that's like 5,250 trading days or whatever.
Yeah.
It's even more mind-blowing that a lot of these best days happen during bear markets, markets under its 200-day moving average, as Warren Buffett says.
Yeah.
And that's exactly it. Like that's really important to know that when markets go down, they don't just go down. You have really the best days during those times of turmoil.
Correct.
Today's a great day.
Right.
Today's a perfect example of it.
Perfect example of it, right? With the markets rebounding 5-6%, right, on most stocks.
Yeah.
So finish.
So basically, missing 10 days out of 5,000 plus days halved your return.
It's insane.
Okay. If you miss 20 days, I think you only made 10 grand over that time period,
right, so
or something like that. And if you missed the 30 best trading days over 25 years, you basically made no money. Yeah. Okay.
I mean, if there is no better argument, just stay in the course.
It's crazy. And you stay in the course. And when I share this with my clients, I almost always get wow, that's kind of crazy. So since we cannot tell when the market corrections are going to happen.
That was going to be my question. Can you tell what's going to be?
You can never tell, right? There's some charts that go, well, if you miss the worst days, then you're never going to miss the worst days because you have no idea when they come.
Yeah, and even breaking it down to the yearly level, like if we talk about that 10% average return per year, if you just miss the best day out of that year, which again happens during bear markets most of the time, that 10% average return falls to 6.
Yeah.
Damn.
And if you just miss the 2 best days of the year, you're pretty much best off sticking with a bond or high yield savings account this year because your return's down to 3%.
Just crazy, right? To think about
2 best days.
If you literally miss 2 days in the market,
it's insane.
Then you might as well be in a money market account.
Yeah.
Right? So the bottom line is just don't do it. Don't try. Don't worry. Don't think. Think about what your goals are.
I think Fidelity did a search and all the accounts that they managed, and the best accounts were the ones either people that died or people that could not access their accounts, they could not trade. That's actually the account that had
it's
like the lost 401k.
It's kind of crazy. If I'm sure you've done this with your clients, and I talk to my clients all the time. The ones who kind of just don't worry and are like, "Oh, I trust you, do your thing," and when markets are down, especially, and they're like, "Oh, I want to add money." They do the best by far.
Those clients make me so proud. I got an email this morning. They're like, hey, I noticed it's down. I'm going to send you some cash.
Yeah.
Like, it almost brought it to
I have a very smart client, too, I met with last night. He's like, I've got some cash. Let's put some money to work.
Yeah.
It's kind of like what you ought to do.
Same. That's exactly right. That's exactly right. And, I think we can kind of move on from this chart. Basically, this chart says that investing at highs or lows doesn't really, you kind of have almost an equal chance of making money if you invest at a high or invest at a low, essentially.
So diversification, you want to talk about that?
Yeah, I mean, we talk about diversification all the time, right?
What's diversification?
Basically, you don't want to put all your eggs in one basket, right?
Right.
Right?
You don't want to own Apple, Nvidia, and Tesla, basically.
theoretically.
Theoretically.
Yeah. For volatility's sake, no.
Yeah.
Unless you're like getting punched in the gut every few years.
That's correct.
Yeah.
Because if we rewind back to 2022, which was not one of the worst correction years, but was very harsh on growth and tech.
Right.
Apple was down 40%.
Nvidia was down.
Nvidia was down 65%.
Yep.
Tesla was down 70%. Microsoft down 40%. Like basically the NASDAQ was down close to 40% at its low. I think ended down 35 or something like that.
Yeah.
And that is very hard for most people to digest.
Yeah, it's easy to like put it in percentage terms too, but when you're watching your $1 million, $2 million account go down by $400,000, $500,000, $600,000, it's a little bit different of a conversation.
This is such a great point.
Absolutely.
Because like we, oftentimes people think in absolutes, but we talk in percentages.
Yeah.
And people have to like understand that.
Yeah.
Yeah. Those are different things,
If my $1 million is worth $600,000 next month, I might feel really badly about that.
100%.
Right? And we always joke that people are aggressive when the market's going up and people are conservative when the market's going down.
So what's if I'm managing a stock portfolio, what's a diversified stock portfolio? How many stocks do I need to own to have to be
there's different like criteria of what companies will think about. They'll say 30 or 50 depending on who you ask, but it's not the stocks per se because if I own Apple, Tesla, Nvidia, like you're basically owning a high correlation of assets, right? Versus if people know the S&P 500, they hear about the S&P. It's a very undiversified index actually.
Such a great point.
Why, Brett? Why is the S&P undiversified?
Well, because now it's super lopsided because all of these tech companies have grown so much that it's become very concentrated in those same positions.
Right. 10 companies are 40% of the index right now.
Yeah.
This was as of 2 months ago. Maybe it's slightly different now, but that's not diversification per se. So you want to have small caps, smaller companies. You want to have mid companies that can grow more volatile.
Aren't small caps down 20% year to date?
Yes. No. So listen. There's a lovely thing that shows. Well, you didn't let me get there. You guys got one.
You got one.
International has underperformed for 15
make
years.
Europe great again.
Oh, it's mega. Is that the new? Is that the new acronym? Okay.
Make Europe.
That's hilarious. Mega. I like it. It sounds better. It sounds too close to mega, to be honest.
That's the pun,
But international stocks. You want to own some, maybe you want to own bonds, and even within bonds, governments, corporates, all different kinds, so that you have access to a lot of different asset classes, so that when the market is crazy, especially like it is right now, you have your a diversified portfolio is actually doing much better now. So this chart shows, we're not going to go into every detail.
Yeah.
The diversified portfolio works, but it never feels good because when the market's flying to the upside, you're not doing as well. And when the market's falling hard, you're falling less, but you're still losing money. But if you look at it over a long period of time, it actually does just as well as a concentrated portfolio.
A lot less stress.
With a lot less stress.
Smoother ride.
Smoother ride, absolutely.
Yeah. And again, like I think that's when you look at all the portfolios you manage, it's very rare we have 100% stock portfolio. We're already thinking through these allocation decisions before a market correction, right?
Correct.
You're not doing this when the market is unlocked. Hopefully you have put yourself in this position.
Yes.
So you can kind of manage.
That's exactly what we did, right? Like we rebalanced a lot of our portfolios in the first couple months of the year. And if we had not taken profits on 2 great years that had gone, this would have felt a lot worse.
And it's important to understand the difference between rebalancing and trading, right? Rebalancing just means you're getting back to the allocation that you were comfortable with when we started this, right? So if 2 years ago your portfolio was a 70% stock and 30% bond allocation, and now it's 85% because your stocks have been flying, like you got to bring that back down, because if the market corrects back to where it was, you're going to be right back to where you were, and nothing ventured, nothing gained, so to speak, right? So we want to move on. We want to do that kind of stuff.
Yep.
And going back to our original point, this next slide is
politics, baby.
Don't invest based on your political affiliation.
Listen, but also this is front. It's top of mind.
Yes,
it's like you turn on the news, first thing, tariffs.
Yeah, absolutely.
Trump says some bullshit or something good, We show up, we think, we're going to have pro-business, less regulation, all these amazing things, right? And then we show up, and the first thing is we hate Canadians.
Yeah.
Like, so people are like wondering, like, what does this mean? For our economy?
And to be fair, any one president may or may not affect the outcome.
Sure.
Right. But over the course of history, if you try to invest with a political party, you ended up missing out on a ton of gains.
You basically have to invest in America,
correct,
regardless of politics.
Correct.
That's
because eventually, whether Trump does a great job or a horrible job, the pendulum will swing,
right,
and it'll come back. And markets may, if they continue to correct, which they may, markets will get cheaper. Money will come in. People will flow in. Business will continue. Like, the business cycle will continue on regardless of this stuff. Now, is it great to hear about tariffs every day and escalating tariffs with Canada? Now with Europe, there's escalating tariff. Like, no, that's not good.
I think we all made this when Trump kind of elected. You know, this is the benefit of being older, is I've lived through 2016 or Trump 1.0, right? And I realized that oftentimes you can react to what he says, but not a lot of stuff actually happens, right? So if you wake up every morning looking at the news and trying to make a decision based on whatever tweet or whatever happens that day, you're just going to lose.
Right.
You know,
absolutely.
And you're going to drive yourself nuts, frankly.
And here's the part that is actually like, right, when people get scared, they sell everything. And that's kind of what Monday felt like. Right. We were sitting in our investment meeting on Monday talking about capitulation, right? If there's a 25% tariff on lumber, why is Netflix down 8%? Like, there's no correlation, right? It's just fear and people, selling assets and buy. And so that's the opportunity to go in and pick up stocks like Google or Netflix or whatever that actually have no bearing. Now, if you're a lumber producer,
it sucks.
It sucks for you, no question.
Yeah. And we do this, right? We look at our portfolios, see what kind of implication have, and this is kind of on the granular side of things. Is you have to understand what the short-term impacts are, but ultimately, as you said, take these opportunities to add to things that just are being sold off for no basic reason. Yeah, right. And you can hate who's in power and still make money, and you can love who's in power and still make money. Listen,
the best thing you can do is make money and then donate it to the causes that you actually care about.
I'm glad you brought that up.
It's such like the capitalistic mindset.
Brett,
like,
I'm so glad you said that, because I tell this to my clients, and again, because we live in LA, especially on the west side of LA, everybody here leans liberal. Most people here lean liberal. So I tell them exactly that. Make your money and then donate it to a cause that you're, passionate about, etc.
Agree. Okay? Wars,
tension,
geopoliticals. Yeah, let's talk about that.
Again, people fear this kind of stuff. War with Ukraine, what we've learned over the course of history is even something like the Pearl Harbor attack in 1941, which was obviously probably the most.
Man, you're going back, bro.
Yeah. Well, I'm trying to think of the ones that are the most. That are the biggest deals, remember? Right? No, the biggest deals in history, right? Because on a global geopolitical scale, the Gulf War was a big deal, but it wasn't being attacked and having to enter World War II. Right? Okay, the market was down big, 20% or something when the Pearl Harbor attacks happened. A year later, the markets were up. And actually, throughout World War II, the markets were actually up, which is a crazy thing to think about, which is probably the worst time
to actually invest
in history that we can think of, right? In modern history, like, is there a worse period of time between 1939 and 1945?
Probably
it's
not.
hard to think of it, right? So
you didn't see the end of this. Like, you thought the world's going to end.
Correct.
Yeah.
Right?
Yeah.
And the market went up during that time.
Yeah.
And that's the interesting thing, right? And so, there's more stuff on that. But basically a year, 3 years, 5 years later, like, geopolitical tensions tend to just fizzle out. And once again, what's important is business, markets, right? Are earnings going up? And if they are, that's good for markets.
Yep. Are they going up this year? Yes.
I mean, we were up 18% year over year.
Yeah.
This year, depending on who you ask, we have a 10 to 14%.
Right.
Sort of like earnings.
I think a lot of the earnings drivers, obviously, this new theme that's been in the markets, which is a major theme for a lot of us, is the AI making things more efficient, increasing profit margins.
It's
so it's hard to see all these, especially the major tech companies, get compressed when this new technology is doing so many great, amazing things for them.
Yeah. I totally agree with you. Like you gotta get out of the short term mentality. You gotta look at like what this much bigger theme playing out, which could be as big as the internet, really, if you think about it, right?
For sure.
We're gonna have a new economy starting out next few years and building tremendous amounts of wealth.
Right. So I want to show that like that what we call the mountain chart real quick. And this one's hard because it's very big. So I like to zoom out and then I like to zoom in.
All right, zoom out and zoom in.
So
Alex, can you do that? Zoom out and zoom in, man.
If you zoom out, you basically see, right? It just shows that markets go up over time.
Yeah.
But if you zoom in to any one period, there's scary periods that happen in there. And we just talked about World War I. So I asked my clients, especially the ones who are very nervous about Trump, I asked them this question. Do you think that America is in the worst position it's ever been in today? And some of them will answer yes. And then I show them this chart. And I zoom in on World War II or the Great Depression or the Cuban Missile Crisis. I like to use those examples because those are real scary world events, right? And when you see this, you're forced to sort of come to your own realization that, yes, maybe things feel terrible, but they're not the worst they've ever been.
Yeah.
Right? And then you can zoom out and say, okay, well, if we invest for the long run, this is what it looks like.
Yeah. I just did a training right now with some of the younger people, and we talked about decision making.
Mm-hmm.
And I'm going to go a little bit like talk about the Greeks for a minute.
Oh,
I think it's personal.
This is usually my realm. Hatem's going to history.
I'm talking about Aristotle. Okay? Oh, shit.
Hang on. I'm going to take a sip. All right, go ahead.
Aristotle basically came up with how do we make decisions? Ethos, pathos, logos.
Oh.
Ethos are basically, is a person credible enough?
Mm-hmm.
Pathos doesn't
suffering.
Pathos is suffering.
Yeah.
Or the experience itself.
Yeah.
So how do we emotionally feel about
Listen, we've gone to some nerdy places before, but this is next level, and I'm so proud of Hatem for bringing Aristotle into this.
I got you. And then pathos.
We did pathos.
I'm sorry, logos. This is logical, what you're saying, right? All of us make decisions based on our emotions. That is a number. Again, Aristotle found this up 2,300 years ago.
Mm-hmm.
But we have to have logical reason to actually justify those decisions.
Yeah.
Right? So this is exactly the same thing, right? We are going to act with our emotion first. Trump or whatever politics that we kind of listen to are going to have these emotional kind of really hard things, but ultimately logic has to prevail.
Correct.
For us to succeed long term.
Correct.
Right?
And I know we're running out of time, so I want to skip the last couple, but I want to, based on what you just said, I want to go to the last slide, which is just a snapshot of what we call this Vanguard Advisor Alpha study.
Yeah.
Okay. So Vanguard, for those of you who don't know, is one of the largest asset managers in the world. The
father of indexing.
The father of indexing. I always say that the champion of do-it-yourself investing is what Vanguard is, right? Vanguard came out with a multi-decade study.
I love that study.
Okay. And they renew it every few years.
Yeah.
And basically shows that the people who work with an advisor can have a return of over 3% better than the people who do the same investing on their own.
Yeah.
And it's for all the reasons we just talked about.
Yeah. But it's not that we're picking different investment, by the way. It's just because we're actually helping you behaviorally.
It's logos, pathos, and ethos.
Yes, exactly.
Right?
There you go. Aristotle figured out.
I am now an Aristotelian disciple. And who Alexander the Great, who's one of my favorite characters in history, was his disciple.
Yeah.
So like it really is important to kind of note that being a financial advisor, working with a financial advisor, helps in so many ways. We talked about rebalancing. We talked about not investing with emotion.
Yep.
We talked about adding money when the markets are down. We talk about diversifying. All these things, they sound simple, but they're not, right? When I remember one of my favorites, we went to a conference and they said, how to prepare yourself for a snake attack, right? And they likened it to bear markets. Okay, don't run. Don't do this. Don't do that. Don't do that. So what do you do when the snake attacks?
You run.
Right? It's such a great analogy because that's exactly what happens during bear markets. So that's the point. Just focus on what we're supposed to be doing, where your goals are. Talk to us if you need to, and we'll get you to where you need to be.
We're here, and this is kind of what we're here for. We really, at the end.
Correct.
So let's.
So with that said, let's switch gears.
Let's switch gears. Let's talk about some crypto. So Brett, you're kind of our resident crypto specialist.
Crypto bro,
right?
Resident crypto nerd.
Without the what is your jacket?
Yeah, you should have brought your vest.
Bro. You should have vest. Come on.
How are we gonna bro out if you're not?
I don't know. Gemini is getting on my nerves lately.
No, there's a lot going on. I think a lot of people. Obviously, Trump is very pro crypto. That we have this, I think the U.S. is, I think for good reason, is trying to become the leader in digital assets. And when we say crypto, it's kind of an umbrella term for really digital assets in general, right?
Can we back up? Can we actually define what cryptocurrencies are? I know this is very 2016, it feels like, but like what defines what is a cryptocurrency?
Yeah. When you think about crypto, it's, cryptocurrency. I hate that word's even in it because people just assume that this is something we're going to spend monetarily and that's like the only use case for it. But what a lot of it is it's basically blockchain technology.
Yep.
Without getting too weeds into what blockchain is, it's, a new type of technology that allows these platforms or these cryptocurrencies to do specific tasks or a specific project. So, for example, the NFT boom was available through blockchain technology.
How'd that work out?
Now basically worthless, right? So there's there's a lot of other use cases. You have Solana that's out there. That's a big one. That's trying to essentially create a payments processing system, and then you have Bitcoin, which is the one that everyone knows about, right?
Yeah.
So maybe we separate Bitcoin, right?
Because So real quick, just to summarize here, crypto is the blockchain is basically a digital ledger, right?
Correct.
And stuff gets written on there essentially, and we use that. It could be used for whatever reason. It could be used to
medical records,
like a cool Excel.
Transactions.
It's like a cool Excel.
But it's an Excel that no one can change, right? So it's verifiable from everyone in the public ledger.
Because it's a decentralized verification, right?
Nobody can change.
Nobody can change it.
Yeah. Which is very valuable, right? Because you can use it to document transaction, to monitor things, right?
We'll talk about how it's not. It's not.
If you think about why that was, it was created out of the global financial crisis, right? When people didn't have trust in the banking system, there's no transparency in the banking system, and so with something like Bitcoin, everything's publicly available information. You can go look up who owns what, when they transacted it, and ultimately follow along for the ride.
Who bought all the Bitcoin before the
Well, it's so funny.
Isn't there a bunch of people, because you don't know who they are physically. They just have a number that you can.
Yeah, a lot of the times, if you're in the U.S., you obviously have that connection to financial institutions to try to get your money out, right? Yeah. But that was so funny because, Bitcoin was originally the main use case was for legal activity.
Yep.
Which is kind of ironic considering it's the most transparent technology out there when it comes to money transacting, and kind of, these people were obviously not that smart.
So without going to the weeds too much, let's kind of go back to so Trump has obviously pro crypto, has a lot of the digital asset players, Coinbase and Michael Saylor and all those guys are really kind of leaders in the space, kind of supported him, give him a bunch of money. So now the U.S. is trying to become a leader in this space, right?
There's some things that he's doing that's great.
Okay.
There's some things that I absolutely do not agree with.
Okay. So let's talk about those.
Yeah. So
let's talk about what's great first.
Yeah. So
I said those. I said both of them.
Yeah.
What's great, and this could also depends on how you view the side of the coin, but when it comes to crypto regulation, there basically was none.
Sure.
And this is a technology that the pace of innovation has outpaced the legislation that our lawmakers have been able to put forth to the public.
So the SEC and the
Gary Gessner, all of these people, right? And the main issue on the regulatory side of things was that these crypto companies like Coinbase, like the Winklevossens, whoever it is, they want to be compliant because they want this to be a long-term industry. And they understand that without being compliant with our regulators, that they're not going to be able to grow into the U.S. And they do want to build here, I think, for the most part.
And also it's trillions of dollars, right? And market cap. So we're talking real money.
Yeah, I mean, this is, arguably with AI, one of the biggest changes to the future that we've seen, right, over the past couple decades, besides the internet.
And there is I heard somewhere, over 50 million Americans who own crypto. Like, it's a lot of people that actually have some kind of, either association or want to be part of it, right? So
yeah, and so before Trump got into office, Gary Gensler, who's driving most of the crypto regulation, these people at Coinbase were coming to him and saying, "Hey, can we apply for this regulatory approval?" And he would go, "No."
Yeah, we didn't even know if it was a security, if it's not.
Yeah, we don't know. There's no guidelines, and so they say, "Okay, you're saying no, we can't apply for this. How do we create a pathway to get there?"
Sure.
And he's like, "I don't know."
Right.
And that's what he would leave it at. And so they're stuck in this kind of middle ground of limbo of, are we doing something illegal? Are we doing something?
Do we have guidelines now? Is that?
So I think that, obviously Gary Gensler's gone at this point, and whoever is, taking his place I think that's going to be on the forefront for them.
Got it.
Last week.
So we'll have rules.
We'll more than likely have rules. Whether Trump follows those rules or not is kind of up for question, right? Because you have this big crypto summit that he hosted at the White House on Friday after signing the executive order for the strategic Bitcoin reserve on Thursday.
I want to talk about that.
So, but it's interesting because all the major players went to the White House, right? And they're saying and trying to give him ideas and all these things. Who was a main speaker on the crypto summit? World Liberty Financial, who's Trump's coin and crypto platform that he's supporting.
It just completely defies the purpose of the whole.
So, do I want more regulation? Do I think that it's needed? Yes, absolutely. Do I want the person who's creating the regulation to have a piece of the pie and be in the game? No. Probably not. That creates some really major conflicts of interest there.
Yeah, because, okay, let's talk about the strategic reserve for crypto, right? So Bitcoin, whether you agree or disagree, at least it has some kind of value because it's finite. Yeah. They're never making any more of them. They're having them. So
let's agree. It's an asset class. People own
I'm separating Bitcoin from everything else,
which is important.
Yeah. Yes, because Bitcoin does have a finite amount. So regardless of what you're willing to pay for it, at least you can make the argument that there is a finite amount of it, and therefore it holds some store of value because of that.
Sure.
Right? Just supply-demand economics theory.
Yeah.
Okay? So, number one, what is the strategic reserve of Bitcoin? And then we'll talk about possible other things.
So, when it first hit the news flow, it was a little bit different than what he's, again, walked back his statements on, kind of going to your point earlier on what he says versus what actually happens. You kind of have to decipher there. So, originally, when he came out with this info, he's like, the U.S. is going to create this strategic reserve and it's going to own Bitcoin, and he named 5 other altcoins.
Oh, which coins were those?
Lost their minds. Solana, Cardano, XRP, a couple of the others.
And if you had to say what is shared amongst all those,
it just happened to be the people that donated the most to his political campaign.
So it's a grift.
Yeah, so people lost their minds in crypto land because I was actually really proud of a lot of people kind of standing up for this on social media because they're saying we get it. We all agree Bitcoin should be in this strategic reserve.
Right.
Now, you shouldn't be picking and choosing as the U.S. government which other projects you want to have allocated to this because now you're getting into
based
a situation.
On your friendship or based
on how much money you got.
And it's just he was picking them out of a hat. It wasn't, and there wasn't really much rhyme or reason. It wasn't based off of the revenue that blockchain is.
That defeats the purpose of legitimizing this whole. I think that's really what happens.
Yeah.
Right?
And so that really upset a lot of people. And I think that he realized that. And I think that this last week with the crypto summit and the executive order that he signed, he kind of walked that back a lot. Right, and he was like, okay, we're not going to have any of these altcoins. They might go into a separate entity.
Got it.
But the Bitcoin we are going to have. And then the second thing he mentioned that he walked back on was that he wanted it to be a budget neutral project. So that we're not going to cost taxpayers money
we have
to accumulate
$7 trillion, deficit or debt.
So it's more around him wanting to hold on to the Bitcoin that the U.S. government already owns through seizures like
which we have a few billion of
Silk Road is obviously a major one.
Yeah.
And a lot of those things like Mt. Gox, Silk Road, those were getting moved out of what the government had it held in onto exchanges in preparation to be sold, in my opinion, over the last like 6 to 9 months. So I think that him kind of saying that, hey, we're not going to sell it, even though we're not going to accumulate more, at least we're not selling what we already have in case this does become a more valuable resource in the future in the global economy.
Yeah. Very, very helpful.
So let's talk real quick. So we know Bitcoin, that's the one that most people know and probably most people own. We know there's a lot of, okay, Alex could bleep this out, well, for lack of a better word, coins.
Why is there better words? They're not
that's what they call coins. And then there's some, ones that actually
Isn't
might
there
have
something called the fart coin?
Yeah.
There's all, I mean,
there's anything.
People are literally now trying to name their things crazy things. Like that's how you know, like that this stuff is just ridiculous. Is like they're trying to come up with the weirdest names ever. Like imagine naming like a company that you're taking public.
It's the meme economy.
You know what I mean?
Meme economy. Oh man.
So it's ridiculous. Well, but my question is there are some that actually have some kind of use case theoretically, right?
These are the projects, right?
Ether, Ethereum, Solana. So can you explain? Because I think those are the two other biggest ones, right? Ethereum and Solana.
Yeah.
Is that right?
Yeah. So the two of they're in the top 5-10. As far as market cap is concerned. So it's funny because each cycle with crypto has had a different theme to it.
Okay.
And when there's scammers in an industry and there's no regulation, it's the Wild West, people are going to take advantage of the system, right? So you think about 6-7 years ago, you had the ICO boom, right? Everyone was launching an ICO to raise capital for a crypto project. Then the next one in like 2021 was like the NFT boom, right? And we saw a bunch of fraud with that and people selling pixelated pictures online for tens of thousands, even millions of dollars, right? Crazy. And then this theme is meme coins. So it became very, very easy because Solana and Ethereum had become mature enough with the platforms that were built on top of their blockchain to allow this to happen, where anyone can go in on a different website right now, and me and you can go and create a meme coin. I would say it would maybe take us an hour and no more than $10,000 to get launched. It's incredible. So, Solana and Ethereum specifically, the use case for them is, let's talk about Ethereum. So think of that more like the Apple App Store rather than Bitcoin being digital gold, right? So you log into your iPhone and you have all of these different apps that are available on your Mac software.
Yep.
You can do a banking app. You can do, a creative app where you're creating content. So what Ethereum allows you to have is that platform where it allows you to build these decentralized apps on top of their blockchain. Okay. So they're essentially like facilitating the ability to build these apps on their platform.
Okay. So how's Solana different than Ethereum then?
Yeah, so Solana, I mean, a lot of the use cases have been around monetary. So like a lot of payment processing systems. So, our Swift banking in the US, for those of you who don't know that's like the banking system that we use when you're transferring money, right? We all know if we go and try to transfer our money on a Saturday that it's not going to hit till Monday, right? Or we sell a stock in a portfolio, it takes the next day to settle. The technology to actually fix that is already here. And that's kind of what Solana is doing. They want to create like a one-state machine where they're able to settle all of these transactions. And think about how many transactions are happening every second in America. Credit card transactions, stocks trading, people Venmoing each other, right? And so that's ultimately what Solana is trying to change, is the fact that if I want to send money to my friend in London and it's Friday, that right now, as it stands, I'm better off taking a briefcase of cash, going to LAX and flying to London and giving him the briefcase of cash and then flying back, and it would get to him faster than I would be able to send a wire, because it would take the entire weekend to get to him.
Got it.
Yeah, but then why would I buy the Solana coin? Because it sounds to me this is just the rails on which money moves on. You know what I mean? Like, is this like buying a stock basically?
It's the Solana actual token is what is the engine powering all of the different platforms. So in order to be able to make those transactions, they force you to buy Sol or USDC or something on that blockchain in order to facilitate the transaction.
And the value of that goes up theoretically because it is more transactions happening.
More transactions happening, and then like the things that are staking the Solana, essentially like approving the transactions, they are essentially burning some Solana as well, right? So it's kind of slightly deflationary in that sense, from my understanding.
So once again, I think it's very hard to sort of say how does this become more valuable, and I think it's important to note that because of this, all cryptocurrencies, regardless of how good or bad they are speculative, right? And to reiterate to those who don't understand the difference is the difference between investment and speculation is investment, there's an intrinsic value that comes with it. And that's with real estate or stocks, right? We can argue as to whether Apple is worth 200 or 250 all day long based on how much but it has cash flow that is generated by the business. And if you hold it for a certain period of time, that cash flow increase will eventually come back to you.
Yep.
Bitcoin, Solana, it's all based on what people are willing to pay for it.
Well, not necessarily. Bitcoin, yes, because there's no money being driven into the system. But if you think of a platform like Solana or Ethereum, for example, when people are transacting on Ethereum, it costs money, right? Okay. And these dApps and things like that are essentially those stakers. So if you buy Ethereum, you stake it, you earn a return. That money that you're getting as a return for staking it is coming from activity on the platform. So something like Ethereum, you actually can argue that you can derive a value from it because there is revenue coming into the platform. Now,
but it's coming to humans who are doing it, not to the platform.
But if you own the tokens on the platform, you're getting a share of that revenue.
Yeah.
Right. So like that's the argument of how to value it. Now, the valuations are absolutely incredible compared to the amount of money that they're putting in.
The incumbents are not giving up. Like Visa is not letting you do this, right?
Well, and so that actually, I'm glad you brought that because that was going to lead me to my next question: is how do you have a decentralized system that will then process transactions for people who need to be in a centralized position? Because frankly, I will never send money via Ethereum. Because what happens in a decentralized... I always joke, I go, there's another word for decentralization. It's called anarchy.
No, that's super important because I think that people say they think they want decentralization, but you don't really. And like what I've come to the conclusion philosophically myself of is that I'm a fan of sufficient decentralization. Okay? Because if Grandma gets her Bitcoin stolen. Right now, you can't get it back. Like that money is gone forever. There's no recourse. And when there's no recourse, that means illegal activity is going to pick up because there's no one holding you responsible for the illegal activity that you're doing.
Because if I send a wire to London, even if it gets there on Monday or doesn't get there on Monday, I call the bank and I go, where the heck is my money? And they're obviously
someone's responsible for it, right?
Exactly. And in this case, and that's exactly my point is, that I'm glad you said that, right? Because we have centralization on one side, we have decentralization, so there's got to be like a mid-centralization.
That's
somewhere
the only thing
in the middle.
I can come up with in my mind is I've kind of coined the term sufficient decentralization, like just enough where like no one party has the maximum amount of power, but that there's still some recourse if something goes wrong that it can be corrected.
Right. And so like, do we envision a future where your JP Morgans or your Visas are using Ethereum or Solana to transact on their platforms, but ultimately they're holding the keys.
We know, for example, the New York Stock Exchange is trying to use blockchain to settle fixed income trades. So I think these technologies will be incorporated in some of these transactions. I'm not sure they're going to go fully decentralized, like you said.
Yeah. So the question is are the centralized players going to be the ones holding the keys in the end to decentralization?
And then we just end up in the same
the same pattern, which, by the way, is the same pattern it's been in for centuries. The people who hold the power eventually get the power back.
And again, and this is going back to my Greek You know,
let's bring it all together, baby. Let's bring it all together.
It's important. Like, it's hard for us to understand here in the U.S. because we have so much trust in the banking system, as much as people don't want to think that. But like in other countries, it's obviously a lot more of a use case. Right?
Yeah,
like,
we look at inflation numbers today, and apparently the inflation number in Argentina is 52%.
Yeah,
52%.
Or you remember like Danilo talking about growing up, like,
and it's down from like 70 or something. It's crazy.
So yeah, I mean, in these countries, like it is a lot more important to them to have these, you know, technologies or this decentralization, because
I mean, listen,
we
were in Brazil, like you basically use digital currency everywhere you go in Brazil. You know what I mean?
But not actual crypto.
You're not actual crypto, but like you know, apps. You know what I mean?
Yeah. So the digitization, again, I agree wholeheartedly, and my hope is, again, Bitcoin aside, is that whether it's Solana or Ethereum or whatever other platform comes along, you know, needing to settle a transaction in a day, needing to spend 3 to 5 business days to wire money or whatever, like it's just nonsense in today's world, where we now have quantum computing chips.
Yeah.
You know what I mean? And we can't send money from point A to point B instantaneously. It's just nonsense.
So let's kind of wrap it all up.
Yeah.
I think. Thank you for being here, Brett, for sure.
Yeah,
this is like this. Me. Yeah, this topic comes up a lot. Like we, as financial advisors, like we want to try to understand what's the right allocation for clients,
if any,
right?
Yeah.
You know, and also like the emotions around it, right? Like FOMO. You know, Bitcoin is going up. It's the best asset class the last 10 years. Everyone's freaking out, but ultimately, what are you buying is a very speculative asset.
Correct.
Right.
Yeah.
So you have to make sure it fits within your asset allocation, because when you have a correction like this, Bitcoin's
down 30%.
30% in 2 weeks.
2x usually. I think Bitcoin bear markets are like, I consider it 40% instead of the traditional 20.
I actually read I think the beta of IBIT, which is the main Bitcoin ETF, is like 1.7 or something like that. So it goes up up and down 170% at the rate of the market.
And I love what you said, right, about like it's not right for everyone, and like don't think Bitcoin is safe. Like it can, you know, Satoshi, who we don't even know who created it, first of all, and like if that guy owns a ton of it, like if that wallet wakes up one day, like you're gonna see Bitcoin go down 70-80% and like over the course of weeks. Like it'll be insane. So like there are unknowns out there, and you should never be investing in crypto with anything that you don't expect to lose 100% of.
Yeah.
Great advice. Awesome. Thank you for being here, Brad. We are here going through these you know, ups and downs and turmoils and taking advantage of them. So talk to you guys soon.
All right.
See you in
Brett,
April.
Thanks for coming.
Cheers.
Thanks for having me.
Thank you.
Cheers.